This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and pick up from where we last left off in the previous lecture. In that previous lecture, admittedly, it was very IAS 18 focused. And although IAS 18 is not on the syllabus any longer, I still think it's important to go through there and appreciate the issues that we had with the old standard, so that then helps you understand the reasons why we have the new standard, so that those issues have then been covered. By going through then and looking at that previous video, we should now realize what the weaknesses were before we now then address them in this following video. Okay, so now the focus is on IFRS 15, that new accounting standard, as it says up there, revenue from your contracts with your customers. So let's go through and just see where we did last leave it off. I think it was there, wasn't it? The previous slide that we went through and looked at, having gone through those various examples, spoke about the issues that some businesses would have. We made particular focus, didn't we, on the telecommunications business, because the telecommunications business, mobile phone providers essentially go through there and sell mobile phones and a mobile phone contract with it that provides you with your minutes and your data usage. We go through now and start to look at how we split that according to the rules on IFRS 15. Again, in terms of software development, the issues there, are we providing goods? Are we providing services? With regards to the services, are we going to look at the services as one big bundle, or are we going to split out those services into their constituent parts so that we can then allocate the price to those specific parts and recognize it appropriately? In terms of real estate, that's essentially the sale of your houses, isn't it? Instead of going through there and recognizing the money that you receive, remember the money that you receive on selling a house, if you're an estate agent, it is passed on, if you like, to the seller, isn't it? We need to go through there potentially and think about how we deal with the commission. Okay, so let's go through, play around with it, see how we get on. The key bit with IFRS 15 is that there is a 5-step process. So it's sandwiched, isn't it, between your, if you like, US standards where things are very rules based, and under your international standards where it's very principles based. We sort of have a happy medium between the two, in that there aren't so-called rules, but there are steps to follow, and then within those steps, that's when you can apply your judgments. So what you have there are the 5 steps. You need to make sure that within any exam question that you know what those 5 steps are, because if you know what those 5 steps are, it's going to be much easier to apply those steps to the specifics that are there within the question. And if you're thinking 5 steps, potentially you're looking at 1 mark per step with associated specifics, so potentially 5, hopefully straightforward marks before you then go through and play around with the numbers and the accounting entries. So the 5 steps that you've got there, up there, just above my right hand shoulder, are that you're going to go through there first of all and identify the contract. So when we are going through there, entering into a sale, there are 2 parties to it, aren't there? A little bit like financial instruments, in that there needs to be a contract. If there is a contract in place on the sale, and we'll talk about the details about a contract, it doesn't need to be physically written, it could be verbally or implied. So we'll talk about it in a moment, or we'll just repeat what I've just said. But there has to be a contract between ourselves, the seller, and, if you like, your customer. You then need to go through there and identify the separate performance obligations. So that's fancy speak, isn't it, for saying there's a contract between 2 parties. What specifically is provided within the contract? Is there more than just one element to the sale? So going back to our examples with regards to the mobile phone, there was a sale of a mobile phone, wasn't there? But don't forget, there'd be potentially more than one performance obligation, because as well as selling the phone, we're also providing as well a service with regards to the provision of the minutes and the data usage. So we need to we need to go through and identify the contract, and then within that contract, identify the performance obligations. The third step to go through and consider is looking at the transaction price. So how much are you going to pay overall for this contract? So that's the total price that is going to be paid. Once we've got the total price, we then need to take that total price and allocate it to the performance obligations that we've identified in step 2. So part of that total price might go towards some goods. Part of that total price might go to the provision of some services. That's what we do in step 4. We split out that total transaction price amongst the different performance obligations. We've just spoken about 2 obligations. There could be more than 2 in complex real world scenarios. I wouldn't have thought that within any big exam questions you're going to get more than 2 performance obligations, but don't quote me on that. Then what you've got, the final step, is the actual accounting, the debits and the credits if you so wish, going through there and recognising the revenue, recording it within your financial statements. So there's a 5-step process. What are the 5 steps? Can you remember? They're there, aren't they? You need to remember them. You need to identify the contract. You need to look at the performance obligations. You need to determine the transaction price. You then need to allocate that price to the obligations before you then go through and recognise the revenue. You may have seen it in other tuition providers' books and elsewhere, but I think you can develop a little mnemonic. Is it there? COPPAR. C-O-P-A-R. You need to identify the contract. You need to identify the obligations within the contract. You need to work out the price. You then need to allocate that price to the obligations before you then recognise the revenue. A nice simple mnemonic. You've seen mnemonics right the way throughout F3, F7, thrown the odd one into P2. I'm not a great fan of them, but so be it. It helps some people. It doesn't help others. You know, people remember COPPAR. Go into the exam like COPPAR. Well done me. I can remember what it is. But you can't remember what the actual letters stand for, can you? That's the challenge that you have. And then even when you've remembered, it's the application of that mnemonic that is going to get you the marks within the exam, isn't it? Okay, so don't just go into the exam going COPPAR, 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 COPPAR. Know what it stands for and be able to apply it within the real exam. Got it? Sure? Let's move on. Okay. So let's allocate, or let's look, shall we say, at the different 5 aspects in a little bit of detail. So build it up step by step. And when we're talking there about identifying the contract, the key bit there is that there doesn't have to be a physically written contract between the 2 parties. You know, if you're a major supermarket and you are going through there and selling goods, there doesn't need to be a contract between yourself and that other party, does there? You know, there is, if you like, an implied contract that you are going to pay for those goods. Okay, but obviously when you're looking at a mobile phone and the provision of the minutes and the data usage, that's over 12 months, that there's likely to be, isn't there, some form of written contract. But the key bit is that the contract can be written, it could be verbal, it could be implied. The key bit there is that, again, going back to the framework, that there needs to be some substance behind it. Okay, there needs to be something there that exists in the real world. Okay, again, that's going to go through there and have the terms in terms of the price, in terms of what is actually being provided, which helps us with ultimately the second step. And again, going back to what you've seen within the framework, it needs to be that contract means that it will be probable that we will go through there and receive some form of consideration. Usually that's cash. It could be there essentially some other consideration, maybe some goods in terms of a switch as a barter transaction, exchanging one set of goods for another set of goods, but let's not worry about that for the time being. So in terms of the contract, it needs to be, remember, written, implied. Okay, and then what you've got there is the second step is going through there and looking at the P is, careful, Christopher, getting carried away. C, contract. O, obligations. So the contract will detail the obligations. The obligations essentially are just promises about what you are going to deliver for your customer. And the way in which we go through there and think about splitting out those obligations is to go through there and look at what happens if they are distinct. So if the terms within the contract show that particular items could be sold separately. If they can be sold separately, then that is a performance obligation. If they can't be sold separately, then there is no separate performance obligation. They are considered as one performance obligation to which the price will then be allocated later on. Okay. So I think the example here we have got within the notes. The remaining examples I haven't put in there because I will update them as I go along. So what you've got there, example number 1, all about performance obligations. It wants us to identify the performance obligations under the contract between Parks and BA. So it says there, Parks has sold a new booking and reservations software system to its biggest customer, BA. The sale of the software system contains other contractual obligations that Park needs to meet. So within the contract, yes, we've sold the software system to our customer, but we've promised them other items within the contract. We've got one contract. We then need to go through there, don't we, and identify the obligations within there. Okay, there's one contract. There may be more than one obligation. So what we've got here is we have a software and license, an installation service, technical support, and software updates, haven't we? So the key bit is which of those could be sold separately. Well, the software and license, obviously that can be sold separately, but without having that software installed, it's not actually going to be operate in the manner that's intended within the contract, is it? So there, I would have thought that the software, the license, and the installation service would all go through there and constitute one performance obligation. You can't really sell the installation service separately, can we? Because it's part of the software package itself, isn't it? Okay. If there was no software, there'd be no, if you like, installation service available. So we couldn't sell it separately. However, with regards to technical support and software updates, I suppose that's something, for BA, the customer, to decide upon itself, isn't it? Okay. You know, could BA buy the technical support separately if it didn't enter into the initial contract? I'd have thought so. The software updates. If BA didn't buy the software update as part of the initial contract, could it buy it separately afterwards? Potentially, I would have thought so as well. Okay, so those two obligations, the support and the updates, would therefore be separate performance obligations. So if we were to know the price of this contract, we could then split that price between the 3 performance obligations that we've so discussed. Okay, key bit is, are they standalone and can they be sold separately? Okay, if you can answer that, then you should be okay within any exam question. I've summarised it there. I think what we've got in the answer at the back of the notes. Okay, so the provision of the software and the license must be considered together as a single performance obligation because they are produced, or they are used, to produce a combined output, and the installation or modification could not be provided on a standalone basis. The technical support and updates are both distinct and could be sold alone. So they are separate obligations. So therefore there are 3 obligations. Okay, excellent. Step 3. Okay, remember, first step, contract. Second step, obligations. Third step, P, is to look at the price, isn't it? Okay. So with the transaction price is what we expect to receive for the goods and services combined, isn't it? What we've got to consider are any financing components. So if we expect to receive the money in 2, 3, 4 years, maybe there's a financing component in there. We need to do a bit of discounting back to present value and recognise an interest portion of the transaction as well. However, the standard does go to say that if it's anything less than a year, they're not too worried there about any financing components. Anything longer than a year, then there could likely be a financing component allocated to the transaction. Okay. Variable consideration. So if there's performance bonuses, contingent payments, include those at their expected or most likely amount. Again, that's when they are more likely than not to go through there and be received. Okay. If you don't expect to receive them, don't include it. But I'd have thought there that if you've got a performance bonus or contingent payments, the likelihood there is the reason they are in there is that you are going to meet them. Okay, so that would usually be included within the transaction price. And then any refunds, rebates, key bit there, that's money that you get or pay to your customer if they buy a certain amount of goods. Just be careful there, because we're paying money back to the customer to encourage them to buy more. Then that reduces the transaction price. So just be careful upon that one there. Okay, tiny little piggy bits. Quick example. on the transaction price, it goes through there and says, as the requirement, what is the transaction price? It says there, Lookers sells a car to a customer for £10,000, offering interest-free credit. There's no such thing as interest-free credit. Okay, it's a selling gimmick, and there it's for a 3-year period. So as it's there for 3 years, there is a likely, I'd have thought, to be some form of financing component. So even though we get £10,000 for the car in 3 years' time, we've sold the car today. The car is delivered immediately. So therefore we would recognise the revenue for the goods. But we need to work out the value of the goods based, if you like, in present value terms, isn't it? Okay, yeah, stripping out the financing component on that transaction. Well, market rate of interest is it at 5%? So we'll use that 5%. We'll use the 3 years to discount the £10,000, dollars, back to present value. Okay. So what have we got? So as I said, the 3-year interest-free credit period suggests there's a $10,000 price, but within there's a financing component. Financing component means interest. Okay, that's it in its most simplistic terms. So to discount it back, 10,000 multiplied by a discount factor for 3 years at 5%. So that's 1/1 plus the discount rate to the power of n. N is 3. The discount rate is 5%. Remember, that's 0.05 as a decimal, isn't it? So as you've got it there, it's 10,000 divided by the 1.05 cubed. And that should give you a discount factor, is it 0.8638? So if you do 1.05 to the power of 3, do 1 divided by your answer, it should give you 0.8638. Yep. Did on my calculator when I did it, so I'm going to assume that it's correct. Okay. If it's not, let me know in the comments, like you normally do. Thank you. So what you've got there, 10,000 multiplied by 0.8638. Even I could do that one, $8,638,000. Okay. So that's the value of the transaction today. That's the amount of revenue that we would recognise for the sale of the goods. We'll touch upon the interest, if you like, later or elsewhere. It's essentially just unwinding the discount, isn't it? Okay, so you apply that 5% to the 8638 receivable that you have recognised, and you'd apply 5% each year and charge that as interest income. Okay, hopefully after the 3 years, the 8638 will have grown to the 10,000, and then when you receive the cash, you debit the bank and credit the receivable. Okay, so it's splitting out the transaction into the goods and that interest or that financing components. Okay, as I said earlier, anything less than a year, not worried about. Step 4, COPA. So A is to allocate the price of the performance obligation. So you've got a total price for all of the obligations in the contract. How much goes to each obligation? Well, what we look at there is we've got the contract price, but what happens if there wasn't a contract? If all of the obligations were to be sold separately, then what would the total price be? Okay, once we've got the total price, we can then use that to allocate the contract price to the individual obligations. Ooh, sounds complicated, doesn't it? So let's go through and have a look at a little example. Okay, so it goes through there and says in the requirement, how is the $10,000 contract price allocated to the separate performance obligations? Note, made it a bit simpler. Ignore any discounting and time value of money. Okay, because I think here, yeah, it's a 2-year maintenance package, so technically there will be discounting involved. Forget about it. So it says there, Richard Co sells home entertainment systems, including a 2-year repair and maintenance package for $10,000. So there's likely to be a contract. Within that contract, there are separate obligations, aren't there? Because you've got there, is it the entertainment system and also your repair and maintenance package. The total price is there, is it as $10,000? So it's that $10,000 that needs to be allocated to the entertainment system, to the repair and maintenance, based upon their separate standalone prices. So if I was to buy the entertainment system separately, how much would it cost? If I were to buy the repairs and maintenance package, how much would it cost? Look at that in total, and then I can say, well, of that, X belongs to the entertainment system and Y belongs to the repair and maintenance. Okay. Yeah, so what are the standalone prices? Well, they're given there, aren't they? We're told there that you've got a standalone price for the entertainment system of $9,000. It's a pretty good entertainment system, that, isn't it? And a $2,000 maintenance package. Okay, so the contract price is $10,000, which is a bit cheaper than the standalone prices of $11,000, isn't it? Okay, so of that $10,000, how much is going to be allocated to the entertainment system? Well, if the total price is $11,000 based upon the standalone prices, if $9,000 of that $11,000 relates to the entertainment system, then we'll give 9/11ths of the 10 to the entertainment system. If, okay, as we have it there, the 2,000 that relates to the repair and maintenance package, yeah, so 2,000 out of the 11 relates to repair and maintenance, then we'll allocate 2/11ths of the 10,000 the repair and maintenance contract. It's common sense ultimately, and it's a pretty logical method of allocating things out. So let's go through and just have a look at it there. So we've got the two performance obligations, haven't we? Provision of the home cinema system or entertainment system, the repairs and maintenance contract. The total standalone prices there is it as 11, so the 9 plus the 2. The transaction price, so the price that you have there within the contract, is there as 10, isn't it? And if you do 9,000, which is the standalone price, of the entertainment system and the standalone price of 2 of the repairs and maintenance, then 9/11ths of 10 is 8,182, and 2/11ths is the of the 10 as 1,818. Okay, you can always double check just to make sure. If you were to add them up, the 8,182 and the 1,818 should come back to the total price, isn't it, within the contract. Okay, how do we then go through and recognize them? Well, that's step 5, isn't it? Because what you've got there is the home cinema system or the entertainment system is goods, and then the maintenance or the repairs and maintenance is services, isn't it? So that comes back a little bit to what we saw in those very early examples under IAS 18, goods and services. So goods are recognised at a point in time, services over a period of time. Okay, so as it says there, remember RCOPAR, copper, contract, obligations, price, allocate, recognise. Okay, yeah, got them? Sure. If not, write them down. That's the best way to remember them. So revenue is recognised when control. So again, going back to the framework, key concept there, isn't it? Control transfers to the customer, and so performance obligation is satisfied. This may occur at a single point in time, which is usually with regards to goods, isn't it? Or over a period of time, which is usually with regards to services, isn't it? So in the earlier example, was it with Lookers going through there and selling that car? Yes, there was an interest-free element. Don't worry about that. But in terms of the goods, the customer had control of the goods when the car went off the forecourt. Okay, if they crashed it straight away, tough. That's their own problem, isn't it? Okay, control passed as they took the keys and as they disappeared off into the distance. Okay, hopefully happy with the car that we've sold them. Okay, so what we're going to do, just try and piece it all together, going back to that very first video whereby we had the issues. Now IFRS 15 should mean there's no issues with regards to revenue recognition. I'm sure over time, as things in the real world in terms of revenue get more and more complicated, then things will occur and things will need to be updated in IFRS 15. But we're going to use that earlier example. Telefonica sells mobile phones, and we need to go through there and recognise the revenue. So it says, explain how the revenue should be recognised in Telefonica's financial statements. So it says there, Telefonica sells mobile phones, remember, for free when a customer signs up for a 12-month contract. Okay, the contract costs $45 per month. So 12 months, $45 per month. Is that, I think, $540 in total in terms of the price. Okay, there is a contract. We've got the 12-month contract. The obligation, there's a phone, and the contract for 12 months. So presumably there are minutes within there, called data charges if you want to call them. So there are 2 performance obligations. What we need to be able to go through and do is we need to go through there and allocate that $540 to the phone, which is for free. Okay, that's just a marketing gimmick. It's not. Okay, you've paid for it within that $45 per month. So you need to allocate it to the phone and the call and data charges. How do we do that? Well, we look at the standalone prices. Okay, so that goes back to our old example again. Remember, Vodafone sold mobile phones without a monthly contract. The handset was $240 and call and data charges are $20 per month. Okay, so the phone was $240, the call and data $20 per month. $20 per month, 12 months is that $240. Okay, so the total standalone price I think is it $480. Okay, so let's have a look at the answer. 5 steps, 5 things to talk about within the exam. 1, identify the contract. Here there was a signed agreement, wasn't there? Okay, so there was a written agreement. There was nothing verbal, there was nothing implied. Okay, it's physical, signed, date. Identify the separate performance obligations. We've done that. The sale of the handset, the goods, the provision of call and data services. So is that the goods and services? Determine the transaction price using the standalone prices. So you've got there, is it $480? Okay, and then you allocate the transaction prices to the performance obligations. Okay, so the handset of the 540 within the contract, 240 of that 480. So is that half goes to the handset? The calls and data, half of that goes through there, doesn't it? As well, because that was 12 months, was it? At $20 per month. So half of that as well goes to the call and data. Okay, so that 540 contract price split between the handset and split between the calls and data. Okay, 270 each. In terms of recognizing the revenue, the handset, that was goods, wasn't it? So control transfers at that point in time. So you'd recognize revenue of $270 initially. And then the calls and data will be spread over the 12 months. So you would take, the 270 and divide that there by 12. And you would recognize 1/12 of 270 every single month. Okay. Excellent. IFRS 15 is making quite an appearance in some of these exams, so it's important that you go through there and look at the first video. Even though you think, well, it's IAS 18, it does go through and explain the reasons why IFRS 15 has been developed, and I think that's important to understand. Likewise, as well as going through and looking at that first video, I think you need to watch this video a few times over. Once you've done that, understood how to go through and work the 5-step process, start practicing some of the questions in your chosen tuition provider's revision kit, and then go through there and have a look at some of the recent past exam questions. They haven't so much appeared within the first question, question number 1, that they've been more within question 2, question 3, and there was a current issues question on revenue not so long ago. Okay. Other than that, that's it for IFRS 15. If you've got any questions, you know where we are. We're there on the Ask the Tutor discussion forum, so fire away with any questions as you meet them. Other than that, see you all for now.